Tony Rodriguez, the yield on the 10-year Treasury has dropped below 2% on the heels of this worse than expected October jobs report. In your view, where will the 10-year Treasury yield be at the end of the year?
So I think we're going to see it back over 2%. I don't know that we'll get as high as 2.25%, which would have been my forecast prior to the jobs number. But I think right now the 10-year, the Treasury curve in general, has a pretty significant safe haven bid to it, as concerns have been in the market around global growth. And so I think right now it'll take, obviously not today's jobs number, it'll take some data maybe on the consumer as we go through the month, which I think remains relatively healthy, and maybe a jobs number next month, which is a little bit better than what we saw today, to kind of get the 10-year Treasury moving back above 2% before the end of the year. Maybe not quite as high as 2.25% as I was expecting.
And when it comes to this data-dependent Fed, what does this number mean for them?
I think it certainly delays them. I think they want to get off zero. They want to hit the liftoff date, but they're very cognizant of not doing it in the face of weak economic data, whether it's U.S. or globally. So at the margin, this number delays them. We never thought they'd do it at the October meeting anyway. So I think December would still be in play if we see a strong jobs report next month. Otherwise, as the futures market is pricing in, we're looking at next year.
The other thing in bond world that people are watching is the high yield market. It's really sold off considerably in recent weeks. What's your view? Is it safe to be in high yield now?
You know, we think it is safe to be in high yield. We think it's a very good opportunity right now in high yield. I don't know that you're going to see a recovery in the next 1 or 2 months. I think it's going to take some time. But right now, the high yield market, it's really dramatically underperformed in the third quarter. We think it's pricing in a pretty high probability of recession, much higher than what we think is likely. So the actual fundamentals in high yield remain relatively healthy in terms of earnings, cash flow, debt levels, access to financing. We think that the market will come to appreciate that slowly over the next 1 or 2 quarters. So it's a good entry point for high yield. There may possibly be a better one, but I think you'll be happy with having entered the high yield market now when you look out 2 or 3 quarters.
The muni market, meanwhile, has held up very well. I think perhaps people are pulling money from stocks, hiding it in munis. We saw the S&P sell off, I guess, 7% in September. Is that what's going on? Take the money out of stocks, stash it in munis?
I think that the high-quality segment of the market, so munis being part of that, treasuries, munis, all have benefited from that risk-off sentiment that's hit the market certainly severely in the third quarter. So yes, munis as a stable asset class with pretty strong credit fundamentals going on in that sector. Yields are obviously quite low, but they're better than zero. I think it's a nice safe haven. I think it has benefited in the last few months.
And we're coming up to third quarter earnings season. So let's talk about corporate bonds. We're going to see them under pressure, perhaps, because of worse than expected earnings? You know,
we are expecting earnings to beat estimates, but be negative. So obviously companies have done a nice job of managing expectations down. So it's a weak earnings environment. I think corporates have already priced it in. The third quarter, they underperformed as well as high yield did. So I think in the corporate market, you've already priced in the bad news around earnings. So I think, again, it'll take a few months of economic data that causes market concerns around global recession to abate a little bit. And then I think you'll see the corporate market recover as well. So I don't think the earnings problem that we're seeing isn't already priced in. I think it is priced in. I think the market will be able to sustain the levels we're at and then improve slowly after that.
All right. Thanks a lot, Tony Rodriguez.
Great. Thanks for having me.
And thank you for watching The Street.